Recording the daily financial news for Saturday. What would that be? The May 20th. Doing this a little late. I apologize, but let's get into it. We need to talk about San Francisco and another big employer giving up some office space. We should talk about what Janet Yellen says about the financial system. Talk about something Jeremy Siegel said that is important. And we need to talk about interest rates and the housing market. Folks, let's get into it. First and foremost, Uber. Yes, folks, looks like Uber is looking to sublet or get out of about 1/3 of their office space in San Francisco. Again, folks, I've said many times, and I still believe that San Francisco is quote unquote dying. It will resurrect or rise, just not today. There will be somebody that makes $1 billion in San Francisco, but not today. It will go through a metamorphosis and will be amazing, I think, on the other side. But we need to get to the bottom. We need to change local leadership. They have caused this. And until they are gone up and down the political stack, San Francisco is in for some trouble. On Saturday, I read a lot about the Foot Locker earnings report, slower sales, lower guidance, basically aggressive promotions coming. What does that mean? Think margin compression, also rising inventory, not a good look. I do think this is a indicator that some specialty retailers could be in a lot of trouble. We will know more this week as we get reports from Best Buy, Lowe's, and Costco. It'll be very interesting to see if Lowe's kind of copies Home Depot's ugly report. It'll be interesting if Best Buy kind of mirrors Foot Locker's report. And of course, will Costco be more like Target or more like Walmart? It'll be important things to look at this week. Jerome Powell was out talking about the banking system. He does think that that more rate increases may not be needed because of the tighter lending market. Again, I think Jerome Powell is on board with a pause in June. But of course, he won't come out and say that because he doesn't want the market to get ahead of him. But very, very interesting. John Burns Research is out talking about housing and again looking at the mortgage rate because we have been talking about folks being trapped in their homes or because of rates, right? You have a 3%, you don't trade up with a 7. 67% of homes have at least 50% equity, and almost 60% have rates below 4%. So again, a lot of stuff going on. The balance sheet for most homeowners looks really good. But yes, lots of equity, very low rates, no reason to move. Again, this is why I called it early. And again, just to have it on record, I believe that the spring housing season next year, 2024, won't show up as well for the same exact reason. Janet Yellen came out and talked about the banking system, basically saying, you know what? More bank mergers may be necessary. So again, just like the S&L crisis, we are going to have more, I believe, regional banks and smaller banks fail, be taken over. We will have less banks at the end of the year than we do today. I think the debt ceiling, the Fed talking tough, is going to take mortgage rates over 7%. It would not shock me if we end May above 7% on the 30-year mortgage. That is going to come from the 10-year rising and also the margin, right? We've seen the margin go from 3.04 to, I think, a high of 3.12. Would not shock me if that goes higher because the risk of default is not zero and the market must price something in. So we're seeing a lot of that. It's going to be a tough couple of weeks, but I do believe we'll be at a cycle peak probably by the first, maybe second week of June. And then we just start the slow grind lower as economic data looks weaker, as the Fed confirms their pause, as the recession becomes self-evident. So a lot going on there. Again, we're going to have a resolution to the debt ceiling, lower rates. We're going to have weaker data, lower rates. We're going to have a Fed pause, lower rates. We're going to have inflation fall from 5 to 4 to sub 4 over the next 4 months. So again, lots of stuff coming, but we've got to get through the next 2 weeks. Jeremy Siegel is out talking about a credit squeeze being potentially as high as 3 or even 4 rate increases. We have heard Jerome Powell talk about potentially 1, maybe 2. Jeremy Siegel is out there talking about possibly being as high as 3 or 4. Another thing that we're going to talk about is existing home sales will absolutely, without question, slow down. We know this for a fact. We have learned this by talking to experts every week. Existing home sales slow down at 7%. They pick up at 6%. And as we sit here today, rates are much closer to 7 than 6. So all of us should expect a slowdown. But new home sales will continue rocking and rolling, continue to surprise the crash bros and housing bears. Why? Because if you want a 5% mortgage rate, you don't buy existing, you buy a new home. The home builder will buy down your rate, do a mortgage rate buy down, and you won't leave that table with a 7 or 7.25. You will leave with a 4.99 because the home builder will buy your rate down versus giving you a discount on the home price. Home builders know this is all about payments, so they are doing what they do and getting that payment lower. So expect new home sales to do quite well and expect existing home sales to not do so well. Again, folks, like, subscribe, comment. It is my goal to get you the daily financial news 7 days a week. I do record the Friday and Saturday sessions after the fact. I do still do the reading. I just don't record on Fridays and Saturdays, give myself a break. So like, subscribe, comment, become part of One Rental at a Time. I appreciate it. We are on the path to 50,000 and a party in Vegas. Thank you. Like, subscribe, comment. Thank you.